Okay, so what is up, guys? Welcome to the webinar. Kind of just going to go through this trade that I did today, maybe some education behind that, and then at the end we can answer questions and how answer any questions you guys have and kind of just go along with it. So this trade on SPY, obviously where we're looking for a demand bounce. What was my thesis there for looking at demand in general was because of this large move down off of supply. And when we see a move like this, there's a few outcomes. Typically, especially in the market we've been in, besides this recent sell-off, we've been choppy, right? We've had little moves up, little moves down, nothing really significant. Obviously we had bad news this morning, it pushed us down. Well, we've seen these huge selling candles, and one thing I could have done better is recognize, the price action itself, looking at these huge selling candles. However, when an index like at the S&P 500 moves over 2% in just a short amount of time, I feel like there was going to be relief, and that was my thesis behind even going with trying to find a demand bounce, because relief is expected after a 2% move is huge, like on something like the S&P 500 or SPY. So that was my thesis and that was my thought process. But I'm going to show you exactly what I did wrong and how we can kind of like learn from this lesson together. So first of all, I marked this demand out here, and as we can see, we rejected it off the 2 days ago. We bounced off that same demand, and if we go out to the 30-minute, we bounced that demand again a few days back, or last week. So we had definitely buyers in this area from from 380, around that 380 area. That was my initial thought process, right? And now I have another zone down here, which it looks like it's going to break that one too. So it doesn't really matter, but keep going. So my thought process was, yes, this is a smaller time frame zone. I wasn't shooting for a huge move. I was shooting for just a few candles up. In my opinion, I was looking for more of a scalp kind of trade. But I didn't want to take some type of I was up 10 cents at one point, 15 cents at one point. Yes, you could have taken that and made money, but for me, it wasn't really worth it. And I'm going to dive into exactly what I did. I walked you through on my channel exactly what I did, and I'm going to teach different ways you could trade this, because I was trying to explain to you guys that there was a bunch of different ways that I could go about this. It all depends on your position size. Like Brian, I don't know if you took this trade and if you lost money on this trade, but there's no way you should be risking and losing $18,000 unless you have that money to risk, unless that's how much capital you have. So here to start off, on the 5-minute time frame, I took my first initial position down at this candle of 378.9. Now, why did I take this pre-entry of this zone? Well, the reason why I took this pre-entry of zone is because we got 30 cents. There's some scenarios where this candle will end up coming so close to your zone, it won't give you that fill, and it will push up, right? And for me, I didn't see much opportunity besides this. I wanted to take a little trade, and it wasn't an A+ setup, but the reason why I took this is because I can scale into these positions, right? So I only took less than 25% of my position, my full position right here, which we kept going up, down, kind of like, I was in profit a little bit, but I was only using a tiny bit of my position, so it wasn't a big deal. Now, we come down and enter this zone. This is where I take a bigger chunk of my position size, so around 50% more of my, so I was around 75% all in here, because we entered this zone, and I knew my stop loss would be below this zone, right? So again, I didn't enter any more here. Kind of using 75% of my position size. We ended up rejecting this EMA, right? And we moved down. Now, there's a good lesson to be learned here, and this is that when there's strong price action, there's two types of zones, and I explained this the other day. There's two types of zones. Supply and demand doesn't always have to work out. Just the higher probability is that price action reverse, because there's buy orders and sell orders sitting in. Now, one thing I did say in my chat was that as we came close to the zone, what we realized is that there was buyers present, but all of the all of the buyers were getting soaked, meaning like they were getting heavy. Like we could see that all these pops up were getting pushed down, pushed down, pushed down. So that's not really a good thing we like to see, obviously. And that's why I said, listen, if you guys aren't willing to risk what I'm willing to risk here on this trade, then I definitely would just set the stop loss below this low, not even entering the zone, and just call it a day, right? Because your risk was only 10 to 20 cents there, not even. Like a very, very slim risk. That's why I said, hey, all right, if you guys are freaking out, scared, whatever it may be, maybe you have too big of a position, whatever it is, how about we just take off your risk at this low, right? That's your stop. Because if it breaks this low, chances are, if we get into this demand, it looks weak. So that's what my thought process was. But in my head was, for me to potentially find the bigger move, to the upside, which I was playing, I would have to be entering in this demand because that's what my rules say. So I followed my rules, and we ended up rejecting this EMA. And sometimes in this type of market, and what I found earlier this week, which I'll go to, was that we've been seeing huge moves, right? We've been seeing huge moves that are days are only based off one direction, and in the previous few weeks we chopped around in a very thin zone, we chopped around up down, so we could find these spots where we could balance the market, maybe play these reversals. Well, on these strong moves, maybe that's not a great idea. And that's one thing I failed to realize today. And this is what you have to realize too, is that when I talk about there's two different types of zones, is that this what I was looking for was a drop base rally, right? That's what I was initially looking for. So as we can see, price action dropped. We found the base here. I wanted to see a rally. That's technically the higher probability type of stuff that you see. However, when there's strong moves in the market like this, that I take off full credit for not recognizing it, but this is why trading strategies need to adjust. Just because something works a few weeks ago doesn't mean it's going to work now, right? So you have to adjust yourself, and this is a good lesson to be learned. So what actually happened is a drop base drop. So that's the other type of zone that you'll find, is that there's a drop base drop or a drop base rally in this scenario. And in this scenario, it ended up being a drop base drop. Now, how do we find this out beforehand? Well, I like to evaluate price action, which I said, if you guys go look back at my chat, I said this price action is suspect. So I knew something wasn't right. I knew that my gut instinct was telling me that these buyers weren't going to be able to push this up because the sellers were so strong. As we can see, this whole slow drop, every pop to the upside was getting sold off. Every pop, right? So that's one thing I failed to really recognize. That's why I did say it for you guys to say, if you didn't want to risk what I was willing to risk, to go ahead and place that stop loss under this low. Which, if that was the scenario that you did, that you barely lost any money from this. However, even on this, 5-minute candle down, this was a larger 5-minute candle. So yes, this loss probably hurt a little bit. But however, I like to play the 5-minute candles because what we can see is some type of liquidation actually happen, like a liquidity clear out. So what happens sometimes is that we see a candle come down, a big sharp candle down, and then what we see is these institutions wanted this move to happen, so orders can fill out. People chase this to the downside and to the upside, and they can get all their orders filled potentially to move back to the upside. But that wasn't the scenario today. We didn't see that at all. We didn't see any buyers really take place today, and that's something that is kind of hard to identify. But at the same time, if you manage your risk, for me, it was worth it because the potential move could have been pretty high. I was looking for a potential move from this area to this 381. Obviously, didn't happen. But anyway, so looking at this demand zone itself, it wasn't the strongest demand, right? It wasn't the biggest demand, and I thought honestly this one was a way stronger one, and it still failed, right? It failed very badly. So again, did it really matter? It didn't. I was just on the wrong side of it. This move can't be calculated. this is a move where it's like, you know, you see these once in a while. Like if we go to the daily, we're gonna see how big this red candle is, right? Like, you know, minus 2.7% is a huge move. We see these once in a while. Obviously, we've seen this at the top here, but you know, huge move to the downside, right? So one thing I could have done better was realizing, hey, you know, even earlier this week, I believe it was either earlier this week or last week. I seen the same thing, right? We've seen a actual supply zone turn into a continuation zone to the upside, and that was something where I was like, oh my God, this is a strong move. This was just a consolidation. This happened just to be a consolidation area, and we moved up, right? And that's called a what? That's called a rally base rally, because we're rallying to the upside. As we go to the upside, we consolidate, and then we end up moving higher. So that's one thing that we noticed earlier this week. So one thing we could have just noticed in general is that there was a lot of volatility, a lot of news, and obviously there was a lot of selling pressure coming off this zone. So one thing that I could have done better was analyzing just the overall price action. But in my mind, this was a setup where I was willing to risk it, and it happens. You know, losses happen. There's never going to be a zone that's 100% perfect. There's never going to be a zone that 100% works. There's never going to be a strategy that 100% works. Now, you know, a lot of people anywhere in this industry like to think that they're perfect, and I'm not going to sit here and be the person that says, oh, this is my first loss, like this is the only thing, like I lose all the time. But this loss was a quarter of what I made on Apple. This loss happened to be less than a quarter of what I earned on Apple earlier this week. That ran for over 100%. So what you have to realize is losing is fine. Like losing is perfectly fine, but you have to manage your risk. That's why I said, listen, guys, make sure you're not going full in on this. Like I'm only in a tiny bit on this first position. Then I said, okay, guys, I'm scaling in a little more here because this is my zone. Now, when I scale in more, what does this do? When I scale in more, it brings my cost average down on these contracts, meaning, you know, I have a better fill, my price is better, so potentially if the move up comes, I'll be in profit earlier, and if the move down happens, you know, same thing. I'll be in a little bit less than what I would have before if I can see a little pop. So, regardless of that, should have evaluated the overall trend. Obviously, we respected these EMAs really well. Once, twice, three, like all this whole time down, I should have been looking at that. However, when I was sitting here, I literally did say it in the chat. I just didn't. I wanted to see. You know, I seen this consolidation, and it made me wonder. You know, sometimes it only takes one buyer. You know, one big order to push a candle up to get a reaction out of people. You know, every candle in the market is formed from human emotion. That's how I look at trading. It's formed from human emotion, and it's formed from actual traders like thinking in their mind what they're doing, placing orders, right? So every candle is formed out of human emotions. And what I was thinking was here is that people are seeing this consolidation, respecting this, right? Now, say if we enter this demand and we see big buyers, this would be the spot that I thought there would be buyers sitting at, which if we pushed up a little bit, but didn't work out, right? But if buyers did push up this price, say this candle ends up, you know, closing over this EMA up here at this 379, like we see this one big buyer candle, I guarantee you human emotions would kick in. People will say, oh my God, this is the level that we bounce, and then we see a few green candles up, because this is how the market works. It runs on human emotions. It runs on people's money. So that's why demand zones, and that's why supply and demand is such a great strategy. And this is why sometimes that, you know, you can adjust this strategy to work out in your benefit either way. Because in my mind, right, we lost this trade, but I lost almost a quarter of what I made with this Apple trade that ran all day and the next day. You know what I mean? So there's just some ways that you could even, you know, dial this in more. Like say if you wanted a smaller stop loss, right? We can go down to the 1 minute, and we can say, all right, a 1 minute candle close out of this zone, I'm out, right? And that could have saved you a few red candles down. Okay, now you could have done that. you could go to a smaller time frame to find where you're comfortable of exiting the trades or your risk or reward makes sense. But at the end of the day, I was on the wrong side of this trade, and like I said, you can blame me for it because I take the full responsibility for it, and that's what it is. That's how trading is. I'm not gonna hide anything. Uh, I think total. Let me go check. Total, I lost on this trade $580. Like literally not that much, but like at the same time, what I did is that I made sure I entered this trade properly. I made sure I followed my plan, entered this trade properly. Didn't just see this 5-minute candle push above here and close over the zone, which was a good sign, right? It was a good sign, but I didn't just you know come at the top of this candle and say, oh, like this is my, I'm gonna go heavier because we see this candle close. No, I followed my exact plan on how to I scaled in more down at this bottom of entry around this 378.228. We seen a rejection and I closed underneath of this candle. Now, with that all being said, I've been using a small account for a while, so that's my position sizing is a lot different. However, that was a fairly big loss for my small account. To be honest, I mean like around $600. So, anyways, that's the reasoning of that trade, and that's exactly what I could have done better. Now, with that also being said, I want to talk about these two zones. I have some notes on my other computer here. Oh, sorry. There's continuation zones. So, let's say this. Let's go to the 5-minute, right? Let me explain to you something with these zones. So, this zone here could be considered a drop, base, drop. So this is a continuation zone. Now, these zones aren't particularly traded that much, and that's the reason why are because like no supply and demand is based on reversal scenario, buy orders and sell orders. So when a price action enters the zone that you think is supposed to reverse, typically that's the way you want to play it, right? But there's going to be some points, say if we seen this failing, this fails, say, I really had a deep feeling. I said two things. If you guys go back to my channel, I said, it looks like these buyers are soaking, meaning like they're getting drowned. Like the sellers are just stronger. Like they're not buying this up the way I want it to go. Right. And now another thing was we seen these pops up getting sold off immediately. It wasn't something that I really wanted to see. So as I watch the S&P 500, I watch the main equities. So I watch Apple. Apple, Amazon, Microsoft. The main equities that really can maneuver this, this ETF or this, the S&P 500 as a whole. These type of equities can move the price of this ETF. So sometimes it's nice to watch those as well. So as I watched those, the same things were happening for the individuals. So, I could have made my best judgment to say, hey, we exit this for a loss here, and it is what it is, right? But, I wanted to follow my plan out to full, which I did. But like I said before, this could have worked out like this, right? We could have seen this candle down. Let me just draw this out for you. We could have seen a candle down. We could have seen a candle look like this. So a big liquidation clear out to the downside, and then we could have seen a candle close like this. Right? We could have seen a candle close like that, right? And then we could have seen it. Then we could have seen a candle go like this. Right? So the thing is about trading these zones is that you need to be structured according to your capital expenditures in the trade. So you need to have you need to be structured with your stop loss and how you're going to formulate these trades by your capital per se. So that's why I said, guys, if you guys went heavy here, make sure your stop loss is under this low, because that if you're heavy here, I'm risking down below the zone, which is, a decent move with contracts. So I didn't want you guys risking that amount of capital. That's why I said, listen, I'm in 25%, like really, really light here. Like I'm not taking that extra 50 until we get into the zone and we see some type of buyer step in. As we can see, this pushed up, this 5-minute candle pushed out of zone, then this next candle closed in the zone, but we still seen a bottom wick here. This is where I entered my 50%. Okay, so in all honesty, this loss wouldn't have been 600 even close to 600, but we just happened to see a huge candle move down. So that happens, you know what I mean? And if you wanted to risk less, you can go to a smaller time frame. But I like to use the 5-minute because you can get shaken out of trades. Sometimes, a lot of times, you're going to see a trade work out like this on the 5-minute time frame where this candle gets pushed down and we have a liquidation clear out, and institutions and banks just needed some liquidation to fill their orders. And a 1-minute candle would have closed down here and you would have got stopped out and you would have missed the move. So that happens too. So this is why trading is very hard, right? This is why no strategy is bulletproof. Trading is significantly hard, and this is why we're sitting here learning about it. Because I make mistakes just as everyone else does, and this is what there's not really much I could have realized here besides what I've known. Like I literally typed it in the chat because I knew it in my gut. I knew it, but I wanted to follow my plan. And guess what? The more you follow your plan that you have structured for yourself, the more you can adjust it, the more that you can make it better, the more that, over time, when you see these things with your eye, you say, okay, like, this isn't looking good. Like, I know, I feel it. Like, maybe I should listen to my gut rather than my plan. And there's going to be some points of where, with my gut instinct really told me two different things. One was that looking at the overall picture, we see such a big move that down 2%. In my mind, I'm thinking like, man, there has to be some type of relief. But at the same time, what I should have realized is that we've had significant news. We've only had negative catalyst after negative catalyst. We've only had things to push us to the downside. We haven't had any type of reason to even push up or have a relief, right? And what we've seen in the past is that there is days that we can hold. There is significant days that we can hold this giant downtrend to the downside. So even to the upside as well. So I failed to realize I failed to realize with my gut, but at the same time I followed my plan, which is a win in my book. And all I can do is adjust my plan and give myself scenarios in my plan, right? So what I can do is I have a journal here. I still write down all my stuff on this thing, guys. Every single trade, everything. I mean, I have things back. I have two other journals, but I have things back from 3 years ago that I write down. If I go read about it, I literally just, I would lose and I would literally curse at myself in this book. But anyways, I have a trading plan in there, and what I do is whenever I go into find a trade like this and I see a different scenario like this, because obviously you're not going to see a minus 3% day on SPY every single day. That only happens once in a while. You know what I mean? So, when I have my trading plan, I have a box for scenarios, and what I do is I'll go into my scenario box and I'll say, okay, in this scenario, SPY was down plus 2% on the day already. I found not the greatest demand zones, but I found 15 to 30-minute demand zones where price has previously bounced and broken, right? This zone has been broken before as well. So not the best scenario bounce level. However, this was the zone that I felt comfortable in because on the day we're down 2%. As we can see, sellers were slowing here, right? We've seen some buyers step in. We've seen a little bit of buyers step in. This is what caught my eye of saying, hey, maybe we have some wicks down here. Maybe we have some little bit of buyers pushing up. All we need is really one buyer to really step in to really get a reaction out of people. So, instead of just using my opinion, maybe I could have used my plan to a further extent and waiting for this zone to enter, and then entering this zone when we came down more, and then my loss would have been smaller. So this is what I can I'll write into my journal, and I'll figure out every single day all of my scenarios, because the stock market is different every single day. Like, there's never going to be the same day. There's never going to be the same outcome. No one ever knows. So the best thing you could do is really just calculate what you've done wrong, calculate what you could have done better, and learn from it. And this is why it's so important to even have a webinar like this, because you guys, if you guys just followed me, you wouldn't have any clue of why I lost, right? So now you guys actually have a clue why I lost, and actually have a clue what we can do better. So, and that's what means the most to me, to be honest, guys. Like losing is just part of the game for me, but I know for some people it could be detrimental, and that's why I want to come here and be honest with you guys, because it's in my opinion, it's not worth sitting here and saying, oh, I only lost, like I came out green on this trade, or like saying something dumb like that. Like, I would never do that. It's just not who I am, and it's just not what Teambull is about. So, um, with that being said, that ended up being continuation zone, and you know, to read about it, compared to reversal zones, I have this all noted on my other computer here, so that's why I'm looking over. Compared to reversal zones, continuation zones don't tend to work that well, and they develop from banks placing a small number of positions into the market. So they don't hold the power of reversal zones. So meaning banks usually have the power to reverse. But usually when you see a zone like this where you don't see the move actually happen fairly quickly, this should be a fair sign. Like, let me just draw this out so you guys understand. This right here, this consolidation should have been a fair sign for me to say, okay, we're not seeing the buyer step up that I want. So this could be a sign that a continuation zone could be forming. The development of banks placing a number of positions into the market is not that significant. So they're just trying to make this price actually push farther down rather than push up, right? So that's kind of the theory behind a continuation zone. And I'll be teaching this all on my Instagram too, guys. So if you guys don't follow me on there, please go follow me. That said, they can give you good trades here and there, especially if you know which zones to watch for in particular, right? If I could dial this in my head and back, and I could have used my instincts instead of just following my written down plan, we could have found a really, really great trade. And you know what could have happened here, guys, is that here's what could have happened, right? So we entered this early, and I've learned this from a mentor of mine. Sorry to cut myself off. Sometimes I get all scatterbrained, but I learned this from a mentor of mine a long time ago, and that was that sometimes your worst trades can turn into the best trades. Sometimes you need to reverse your position because sometimes that's your setup. And I learned this from a really, really experienced good trader. And this is one of those scenarios where I knew in my gut that since we've seen this consolidation, I literally said price action looks sus. And if you guys can't risk it, please exit this trade for a 10, 20% loss. However, if I knew this in my mind, if I could have said, hey, okay, this is going to be a continuation zone. We've seen significant selling. All the buyers are getting soaked up. Banks obviously aren't pushing this price up the way we want it to. Okay, so what we could have done here is exit our position, right? Exit our position here off of our stop loss that I sent in the chat earlier, right? We could have stopped right here. Now we could have seen this rejection off this, hence demand zone, but continuation zone, and maybe took a position here off this EMA as a rejection, right? Now what we could have done is, as our risk to reward ratio would be, we enter this as a reversal to the downside. This is going to be our continuation zone. So this is going to be a drop base drop zone. Now our stop loss would be above this EMA or above this candle high. So our stop loss would be above this 379.3, right? So our potential risk to reward would be, with our entry being here, our stop would be, about a 50-cent stop, and our potential reward would have been, my next zone was the zone of 376. So it would have been a potential, $2 to $3 move down. So it's more than a 3-to-1 risk to reward. So this is all stuff that I'll be writing in my journal, and this is stuff that you should be comprehending in your brain, writing down and thinking to yourself, these are the scenarios that you get in on a daily basis. And this is something that I failed to realize today, but guess what? Next time I see this type of scenario, I'm not going to fail to realize this. And sometimes what I said earlier on my channel was the best thing to do. Stop out for a small loss if you're uncertain. If you're uncertain, stop out for a small loss. Now what we can do is we can come back to this trade and evaluate what we could have done better. Because guess what? If you got stuck in this trade with me and you ended up seeing this red candle down and you didn't sell because you were like, oh, well, I'll just hold it. It's going to get better. Yeah, we're already down 2% today. You know what I mean? And this ended up going fully down and now you're still just bag holding. Like, you just completely failed your plan. Like, you completely failed everything. So with that being said too, we have to be, there was ways we could have made this work better and ways that we could have identified things better. However, I followed my plan today and I lost, and now I have a good learning lesson to where I can say, all right, I don't see the sharp move that I wanted to see. I didn't see big buyers. Once we hit this level, I didn't see this candle, see a big move, right? I ideally wouldn't wanted to see a move, like this, for example. Like, I wanted to see a move come up like this. You know what I mean? Like a candle come up and push up, see actual buyers be present. Clearly, this could be a higher probability of being a continuation zone. Banks didn't have their orders set there. They didn't care about this. They wanted this price action to happen because they wanted this to flush more, right? As I said before, one more time, I'll repeat it. Let me just say, continuation zones. There's rally-based rally, drop-based drop zones. These form when price moves in one direction. The base consolidates or pauses, which we've seen right here, and continues in the same direction. These zones always form mid-move, as we see. Like I said, mid-move, we had this whole move down, which I thought was a big enough move, but it was mid-move, right? It happened to be mid-move. These zones always form mid-move, either from banks taking profits or closing trades. So this was banks taking profits or closing trades, guys. As we've seen, they manipulated me, they got the better of me, and that's all I could do is learn from this mistake. Compared to reversal zones, continuation zones don't tend to work that well. They develop from banks placing a small number of positions into the market, so they don't hold the power of reversal zones. Now, on the other hand, reversal zones are rally-based drop and drop-based rally zones. So, like I said, guys, that's really my whole dissection of this lesson, and I would be happy to answer any questions now. I think I went through it pretty well. Is anyone there? Hello? No questions? Or are you guys just not typing? I hope this made sense, and I hope you guys can learn a lesson from this. All right, I'm going to answer these questions as they come in. How could you incorporate a larger time frame setup into something on a smaller time frame like this? Okay, so when you use supply and demand, the key is finding it on a larger time frame. Because what happens is when you look at a larger time frame, you can see the significant moves in the market. Like the reason why I even had these zones, because we've seen decent moves. They weren't great moves. Like they weren't like things I would literally play all the time. But like go look at this 15-minute, right? Right off this zone here, boom, we had a nice push up, continuation to the upside. We go back to this same zone. Had a continuation to the buyers were present, push it up. Now we broke this zone only for a little bit in the aftermarket, but we held it as we came into the market the next day. So I felt confident that there were still buyers sitting at this level. There would be buyers sitting at this level. Considerably, we had such a big move up to the upside. That's was my thesis of it. When you find supply and demand zones, you want it to be on a bigger time frame, and then you want to play it on the 5-minute time frame or a smaller time frame, so you can get a sniper entry and you can get the proper entries that fit your risk to reward. Because sometimes, say if you're playing a daily zone, the zone's going to be so big to the point where like your risk is going to be pretty large, but like your potential your expected move is supposed to be pretty big too. So that's why you play on a smaller time frame zone to really enter that position, so you don't so you don't risk as much as you would if you entered it on a higher time frame zone. If that makes sense. Next question says, when you look for zones, do you start from the daily and refine them to the 15-minute? Yeah, you can go from small to big or big to small. Typically I go from big to small because the bigger the time frame zone, just the better, the more probability it is, and the bigger the expected move it is. However, like how many times are you going to find a daily zone or a 4-hour zone? You're not going to find that every day. You might not find that every week. So sometimes it boils down to looking at the 30-minute and the 15-minute, and the 15 and the 30-minute, in my experience, works so well when the market is in indecision. When it's chopping up and down, it's so good. It's such a good strategy. But what I failed to realize is today we had such a strong move down that I should have said, hey, maybe this 15-minute and the 30-minute time frames aren't going to work. Even the 30-minute time frame here didn't work out well, right? We still denied that. So yeah, it failed. Just everything failed, and that's what it is. It failed. Okay, let me keep answering these questions. Can there be a bounce on SPY? Absolutely. And I would say the best probability you have, by identifying this SPY bounce would be one factor, and that would be price action. If you could see a bullish candle form where you could see clear buyer stepping in, that's where I would say, hey, let's try it for a bounce. Because what happens when you try to identify a bounce like this, right? When we have such a strong move down, there's a few key points that I would like to pinpoint. I use pure price action, guys. I'm more of a price action person, rather over volume or anything else. Now, with that being said, is my strategy better than yours? No, it's just what works for me. I would like to see a big candle close, bullish engulfing candle, and make it be a big one, because I want to see actual buyers step in on this. And what I can do is, right, say if this candle were ended up closing over this EMA per se, if I wanted to take it for a bounce, I would say, okay, my stop loss is below the low of day. And that's it. My stop loss is below the low of day, and I'm willing to risk that, because if that was the bounce, then your potential risk to reward is still there, because say if it closes over this EMA, we see this candle be a bullish engulfing candle. What happens is that low of day is only 30 cents down, and 40, 50 cents down, and your potential reward would be to get back into these levels of I like to use support and resistance to find price targets. So meaningly, if I wanted to take this bounce here, right, say if this was a strong candle, I would say my first trim was at this 376.6, because this was an area of confluence. My next trim is this area 378.2 because it's the area of confluence. My next trim is this 37.79 because it's the area of confluence. And then my last trim would be per se 381. Like that would be how I would structure my trades. Now, would I actually try to take it all the way up to there? Probably not, but you guys get what I'm saying. So how far do I go back to find zones? Primarily, I don't like to go super far back. Maybe like, you know, maybe like I would I always look at the max daily, but like I zoom into like the last year or so, or if I can't find any levels, like maybe like come over here to like 2020 2021, but like you want to play more relevant levels in my opinion. Like I would rather play these levels here. So on the daily, we obviously have strong buyers down at this 348. Like that's the bottom, right? This is what I'm talking about too. Like even on a daily time frame, you can identify things like this. Look how big this day was. This day was huge, right? And we had a candle close above there. Now what happened? We ended up trending to the upside. So like this should be a good sign that we trend to the upside, right? Candles speak words. They speak human emotion. They speak money. So in this case, what I see is potentially this right here looks interesting to me. This to mark it out on a higher time frame is a little more difficult, so I would try to come down. Let's see a 4 hour. All right. So we obviously have buyers here at the zone of 370. Potential buyers right here at this 375. This would be an area that should be on watch, honestly. This is something that I could have actually did better as well, as going on to a higher time frame and saying, all right, let me be more patient, let me be more conservative. But but that all goes to show sometimes it happens to the best of us. So I can't be perfect on any day. So this will be the zone that I draw here, and the reason why I draw it like this is because I go from the low of that candle to the high of this green candle close, not the wick. I don't like to go from the wick here. So this would be my 4 hour demand here. I really just didn't think, in my personal preference, I did not believe that we would get down to this point. That's why I took it so early. Now, here we go. Look, so we have a bullish engulfing candle off of this zone. This could be something where we see a little bit of a reversal here. This could definitely be somewhere where we see a little bit of a reversal. And what would happen was you take this trade here, right? Now, we're still under the EMA. Just keep that in mind. We're still under this EMA that we've been respecting all day. But what I like to notice is that we didn't bounce off of this. We didn't come up and reject. Unless this candle ends up coming down. But this looks like we could have a bounce here. And now your stop loss would be, either at the bottom of this candle, or if you want to risk more, you would go to the bottom of that zone. But the reason why I say playing a higher time frame zone, a lower time frame chart is a little difficult is because look how big this zone is. That's why you would either have to do it two ways. One would either be risking less capital into this trade, or just having total conviction that it's going to work. Or the third scenario would be stopping at the bottom of this low, which I would consider the best scenario. Or give yourself like 10 to 20 cents off the low, would be a good scenario in my opinion. I would like to do the low, but I know some really good traders that I've learned from that typically go from 10 to 30 cents down off the low, as a leeway for their stop. So that could be something that you do. But as we're looking at this here, this is a bullish sign, but another bullish sign would be if this candle can close over this EMA. That would be really nice to see if you were trying to play this as a bounce. yes, supply can turn into demand. Demand can turn. Yeah, zones can flip. Zones can flip. However, I like to play those sometimes. Just like zones definitely flip though. Like say like, as we enter this zone, I guarantee you we probably see a little bit of confluence, maybe some price trying to push this down if we enter this zone, right? And I guarantee you if we get up to this point, we'll see the same thing. We'll see maybe like a red candle down. If we could see buyers off of this level, I think we would be able to break through these. But like yes, we could definitely see these react as more of a as a supply zone now rather than a demand. Um, yeah, so I think I covered a lot in this, and I hope this was really helpful for you guys. Like I said again, like I apologize for the bad trade, but I mean it's just part of the game, man. Um, it's part of the game and it happens. So I hope you guys aren't mad at me, and I hope you guys learned something from this lesson. And you live to trade another day. It's just part of it. So I'm gonna be honest with you guys always, and this is what I think should be credited more than anything else. Is that being honest is more important than anything. So. I'm going to stop this recording. It's been a while.